Friday, December 5, the first Friday of every month, we get from the Bureau of Labor Statistics the change in non-farm payrolls in the United States. Non-farm because the farm sector is too difficult to adjust for. The whole financial world hangs on these reports the first Friday of every month because they're fresh, they're brand new, they're from the immediately prior month. And we also hang on them because the relationship between the job market and inflation has been uniform for a long time, 100 years. Is the lower the unemployment rate gets, the greater the risk that inflation will rise. And today, the financial world dropped its coffee cups when, expecting a middling report of a couple 100,000 jobs, we had 320-something thousand. So on half again the forecast in a pre-holiday short month. The first reaction is, what? And embedded in the report also is the most substantial gain in average hourly incomes so far this year, which have been running about 2% annualized, and in November all of a sudden jumped to a little over 4% gain annualized in the month. And I'm here to testify that I don't know. There's a chance that we've suddenly entered a phase shift in the economy, that the unemployment rate has gone low enough that employers are competing with each other for workers, and all of a sudden have to pay more. And there are times when the economy turns just that fast. And it won't be straight line from here, but a report this strong means the Fed will tighten, probably not sooner, unless there are 2 or 3 more that are like as strong as this one was. But it takes fear out of the Fed. The Fed doesn't need to fear that if it tosses a quarter point tightening into the market, that it risks aborting a recovery. And of course, the Fed is always concerned that it's behind. And the Fed wants to begin to tighten at least a year before the labor market really turns. Now, I said I don't know. My hunch is that this is an outlier. We need to see a good deal of supporting information before we can take it seriously. And the bond market in general feels the same way. A number as strong as this, a surprise as big as this, in markets that are a little thin towards the end of the year, should have driven up long-term rates. Like mortgage rates, we should have jumped well above 4. We didn't. We're still sitting 4, 4 1/8. 10-year T-notes about where it's been. It intercepted a decline which had been underway. That's off the boards right now until we get better data. But this is about as clear a foreshock of a change in the economy as we see. And now we'll all go to watching the holiday sales numbers and a bunch of other data to see if it truly crossfoots to the rest of the economy. But no damage. Our rates are held down by extremely low rates overseas. That's going to persist. It's possible that the Fed will enter a tightening period and not much happens to mortgage rates. Again, because of the weaknesses everywhere overseas. But it's fun once in a while on Friday to come here and say, shoot, I don't know. Have a good weekend.